Marc Ostwald from ADM Investor Services International with some thoughts this week on emerging market currencies. Above all, many of them are commodity producers and therefore should be benefiting from the commodity price rally. I think there's a general point, and I'm going to start off with actually one which is a big commodity importer and very reliant above all on oil, and that's the Turkish lira. That obviously has had a roller coaster ride over the past year, suffering enormously when the credibility of the central bank was put under pressure, when they put in a new central bank governor back in September time, who implemented some credible policies, and we had an ostensible volte-face from Erdogan, so it appreciated. And then as soon as that central bank governor was fired, and it seemed to be going back to the bad old ways of political appointees, so the Turkish lira has gapped wider, and no amount of high interest rates. Base rate in Turkey is 19%, 10-year yields are at 17.9%, can basically support this if you've got bad policies. So let's move elsewhere. I'm going to move to Russia. The Russian ruble, interesting rates have been hiked up here, up to 5%, 10-year yields around about 7.1%. So a relatively shallow curve, but still one which is attractive when one thinks relative to what's on offer elsewhere. And despite all the headwinds from sanctions, it's actually been quite well supported overall. It's well contained within a range, and as much as it's clearly getting support from oil prices, it does seem to be underpinned above all by those higher interest rates than available elsewhere. So let's move to South America. The first one I'm going to start with is the Brazilian real. Obviously oil and above all agricultural exports are very important here. They cut rates down to 2% here and have now had to, with raging inflation, particularly PPI is around about the 30-odd% mark. They've had to start to reverse that very sharply, and that's starting to give some support for the currency. But I think we'll have to see a lot more than the 3.5 we've got. Markets pricing in 5.5, and the 10-year yield suggests there's going to be a lot more at 9.4. And then we come to two copper producers. First of all, starting with Chile, as one can see, took a big hit like all the other currencies, but has recovered sharply, and obviously with the rising copper price, doing very well, not had to really make any adjustments to interest rates, and with 10-year yields only at 3.5%. This is clearly a proper commodity story and proper support. Contrast that with Peru. The next chart is a Peruvian sol, which is basically making new all-time lows versus the dollar and coming under pressure because people are fearful of a leftist government being voted in with a new president, Mr. Castillo, and clearly not getting any support from interest rates either, with base rate around 0.25 and 10-year yields at 5.4. Now to the two final ones. The first one is the Indonesian rupiah. Limits on exports there sometimes basically help to undermine it, as has the fact that it's been conducting QE, which has been unusual in terms of emerging market currencies, but broadly steady profile. But one suspects that with Indonesian 10-year yields at around 6.5%, we'll probably have to see some sort of tightening for it to actually make much more in the way of gains. And last but not least, we've got the South African rand, which I consider to be very curious because it took an enormous hit, obviously struggling economically, above all with huge unemployment, but still nevertheless seeing the South African Reserve Bank managing to cut rates down to 3.5%. However, this one is, I think, a function of where 10-year yields are at 9.2%, a huge risk premium for all the debt that it has and a weak economy. And it really does underline that as much as politics matter and commodity prices matter, 10-year yields matter also. Those are the thoughts for this week.